Silver futures margins just spiked 50% overnight, turning a $12,000 entry fee into $18,000 per contract. That's not adjustment, it's ejection. At $63 per ounce, one contract commands 5,000 ounces worth $315,000. But leverage ratios shatter when the house demands more collateral mid-game. Positions liquidate automatically, not from value collapse, but from enforced insolvency. The price dips under $64. Red candles flash, yet it holds above $63.80, less than 1% down. In a stable system, margins calibrate risk. Here, they weaponize it. This isn't discovery, it's dictation. The drop absorbs, the rally compresses, and the physical bid ignores the paperwork. Something's fracturing, paper control versus metal scarcity. The process accelerates now, as Asia stirs before New York wakes. Watch how the fracture lines trace back through the mechanics, not forward from intent. The exchange's PDF drops late Friday, bearing the hike in administrative prose. No fanfare, just enforcement. That silence signals control slipping, because if the system held firm, no lever pull needed. Yet inventories strain. London vaults report drawdowns, refineries bottleneck, and physical premiums widen 30 to 50% on retail products like Eagles or Maples. Industrial pull doesn't flinch at margin calls. Solar panels embed silver, EVs lock it in circuits, data centers solder it irretrievably. Consumption outpaces mine output, grades declining, new deposits elusive. The anomaly sharpens. Futures print volatility, while physical flows vanish into sovereign stockpiles. Untraceable OTC deals in Shanghai or London. This divergence isn't noise, it's the system bifurcating. Contrast this with 2011's playbook, where margins hiked 5 times in 9 days, requirements ballooning 84%, slamming silver from $49 to the mid-30s, a 30% gut punch. Back then, the rally rode paper leverage, hedge funds, SLV options, speculators stacking contracts on thin margins. Kill the leverage, cave the price. No physical siege underpinned it. Vaults brimmed, supply chains hummed. The trapdoor worked because the battlefield stayed virtual. Now, in 2025, the bid shifts. Tesla secures bars outright. Samsung forwards contracts for solder. Governments accumulate without leverage's noose. The hike hits, forced sales spill, yet absorption follows. Not panic cascade, but strategic scoops. Algorithms lurk at $63.50 limits. Sovereign desks phone in bulk. Ownership transfers, weak hands out, steel grips in. The dip reloads, not resets. Here's where the logic bends. If margins fail to break momentum, why deploy them? Because the alternative exposes the hollow core. Position limits loom next, capping holdings per entity, framed as anti-cornering stability. But it targets scale. ETFs, family offices, funds bridging paper to physical. Force cuts, manufacture supply waves without conjuring ore. Deeper still, liquidation-only mode. 30 days of sell-only contracts, buying banned. Paper drifts to $40 or $50, not from abundance, but handcuffs. Meanwhile, physical clears at $90 in private channels. Industry doesn't pause for rulebooks. Miners redirect to real bids, vaults drain to zero. The zombie market emerges. Futures trade ghosts, claims untethered from atoms. Regulators trap themselves, intervene lightly. Silver surges to $100. Clamp hard, decoupling destroys authority. Interweave geopolitics here, because scarcity isn't isolated. Energy transitions mandate silver conductivity. Global solar installs projected to double by 2030. Each panel consuming ounces locked forever. EVS scale. One vehicle embeds grams, but billions aggregate to megatons pulled forward. Add military overlays, hypersonics, radar, munitions embed silver for precision. Supply chains fracture under sanctions. Logistics choke on Red Sea reroutes. Bottlenecks amplifying. China stockpiles quietly. India imports surge. Physical flows eastward, while Western exchanges fiddle rules. History mirrors this. 1980s peak near $50 crumbled under rule tweaks and margin pressure. A 50% collapse engineered not by glut, but exclusion. Yet 1980 lacked today's industrial veracity. Demand was speculative, reversible. Now, it's embedded, irreversible. Components don't recycle back to bars overnight. The weekend amplifies this rift. COMEX shutters Friday afternoon, 48 hours of Western paralysis. But cargo doesn't halt. Refineries process. Deals ink in Asia's dawn. If the close holds near $64 to $65, it signals vulnerability. Shorts exposed, narratives brew. Anxiety festers in closed markets. Retail logs in, sees red, extrapolates crash. Yet physical dealers feel calls. Premiums spike, delivery slips weeks. This isn't 2011's echo, it's inversion. Back then, paper dominated, physical followed. Now, physical leads, paper lags. The failed hike tests resilience. Price slips to $63.80. Shorts pile in at $63.50, then snap back to $64.90. Not coincidence, calculated absorption. The bear trap springs. Forced liquidations bait. Strong hands collect. Late sellers trap on reversal. If you've tracked similar divergences in other commodities, say copper or lithium, how does this silver setup compare in your view? Drop your observations in the comments. It sharpens the collective lens on where control truly frays. Push deeper into the debt layer because scarcity interlocks with fiat erosion. Global liabilities tower. Governments roll trillions forward. Central banks inject liquidity patches. Silver isn't just conductive, it's unprintable. A hedge against promised dilution. Hold physical, claim scarcity, hold paper, bet on institutional confidence. The margin spike screams desperation. System swinging at shadows, enforcing with spreadsheets what physics denies. Yet absorption reveals the shift. Industrial sovereign cash doesn't margin call. Samsung secures for solar flux, not speculation. This structural demand outstrips output. Annual mine supply hovers 800 to 900 million ounces. Industrial offtake claims 60% and climbing. Investment grabs the rest. Deficits compound. 2024 projections already read. 2025 deeper. Geopolitics tightens the vice. US-China frictions reroute supply. Russian export sanctioned. Peruvian strikes halt pits. Logistics. Container rates triple on disruptions, delaying bars from mine to vault. Military draw. Ukraine conflict consumes electronics embedding silver. Hypersonic programs in Asia pull more. The anomaly compounds. No new mega deposits since the 1990s, grades halving. Production can't ramp like software. It digs deeper, costs soar. Compared to 1980, Hunt Brothers' corner attempted monopoly, rules crushed it. But today's corner is diffuse. Billions of panels, vehicles, devices embedding atoms. No single entity to target. The system itself corners itself. This is the phase where sustainability cracks. Paper mechanisms designed for abundance falter in deficit. Raise margins, liquidate specs, fine in surplus. In shortage, it accelerates drain. Forced sales met by hoarders, vaults empty faster. Regulators face the bind. Let run, expose inflation, intervene, fracture discovery. The 1% dip absorption, signal of physical primacy. If paper hits $40 under liquidation only, physical at $90, miners arbitrage east, COMEX ghosts. Decoupling isn't hypothetical. Retail premiums already preview it, 30% overspot in tight spots. For those in supply chains or mining sectors, if you're seeing these premiums or bottlenecks firsthand, how do they align with the futures tape in your experience? Share in the comments. It maps the real fractures beyond the screens. Non-linearly, loop back to Friday's mechanics. The hike time for weekend psychology. Close week, narrative spread. Top in, sell signals. Yet holding 64 broadcasts strain. Asia interprets first. Shanghai opens Sunday night. OTC desks activate. Gaps lurk. Towards $65 on reopen, trapping shorts. Covering fuels ascent. If no gap, slow grind. Dips bought, floor lifts. Either path, leverage reset strengthens base. History inverts. 2011's cascade from paper purge. 2025's consolidation from physical underpin. The trapdoor didn't kill, it pruned. Overlay industry, semiconductors etch silver. Medical imaging relies on it. 5G infrastructure embeds it. Growth vectors exponential. AI data centers, surge power needs, silver in conductors. Sovereign stockpile, Poland. India add tons, unannounced. This isn't 1980 speculation, it's necessity. Debt backdrop, 300 trillion global, yields manipulated low. Silver scarcity counters dilution. No counterparty risk, no yield curve inversion to navigate. The divergence widens. Futures volatility masks physical lockup. If position limits drop, big holders trim. More supply waves, but to whom? Physical absorbers, liquidation only? Paper slides, physical premiums explode. System loses, control via exclusion breeds parallel markets. Shanghai futures gain authority, London OTC booms. Western dominance erodes, not from attack, but irrelevance. If you've modeled historical hikes versus current demand profiles, what discrepancies stand out to you? Weigh in below with your analysis. It tests the narrative against broader data. Military intersection sharpens. Hypersonic missiles use silver for thermal management, drones for circuitry. Conflicts pull supply. Ukraine's rebuild demands panels, EVs for logistics. Geopolitics. Tariffs fragment chains, forcing regional hordes. Logistics. Suez backups delay shipments, premiums on urgency. The system terabytes. Abundance assumed, deficit reality. Compare to energy parallels. Oil shocks of the 70s mirrored rule, tweaks amid scarcity. But oil flows, silver embeds. 2011's lesson. Leverage kills rallies. 2025's twist. Leverage secondary to consumption. The 50% hike? Test failed. Price holds. Absorption complete. Deeper still. Mine economics fracture. At $63, margins thin on low grades. Below $50, shutdowns loom. Yet demand inflexible. Solar mandates don't yield to price. Government subsidize green, pulling silver regardless. Sovereign bids. Central banks diversify from dollars. Silver as Tier 2 reserve. This is where interpretation forks. Is the hold above $63.80 resilience or delay? If you've seen analogous setups in other metals, how did they resolve? Comment your take. A collective sharpens the signal from the noise. Weekend dynamics underscore. 48-hour freeze lets narratives brew, but physical doesn't idle. Dealers quote higher, inventories tick down. Monday risk, gap higher, short squeezed, or consolidation, building base, regulators cards thin. Limits or lockdown risk backlash, decoupling. Industry veracity. 2025 projections show 1 billion ounces demanded, supply lagging 200 million short. Deficit stack. 2024 already read by 150 million. Consumption locks. 60% industrial, non-recyclable short-term. Geopolitics. BRICS push $, silver in baskets. Military. Space programs embed for satellites. Logistics. Air freight surges on urgency. Costs up 200%. The fracture. Paper manages perception. Physical dictates reality. Margin spike exposed it. System swings. Misses. For traders who've weathered 2011 or 1980 echoes, does this feel like repetition or inversion? Drop your perspective in comments. It aligns the historical mirror with present signals. Final layer. Debt saturation forces alternatives. Liquidity floods erode purchasing power. Silver preserves it. Hold physical. No margin. No counterparty. The hike? Distraction from scarcity. Process phases. From symptom, dip holds, to cause. Demand shift, to consequence. Decoupling potential. System loses equilibrium, not crash, erosion. If you're tracking sovereign or industrial flows, what under the radar signals are you catching? Share in the comments. It builds the fuller picture of where control truly slips. The hold persists, the bid strengthens, the rules bend but don't bind. This isn't peak, it's pivot. The physical endures as paper strains. Silver sits at $66.50 per ounce this morning, up another 1.2% overnight, brushing the highs from earlier in the week. That's not consolidation, it's confirmation. The December 12th margin hike, 10% across front-month contracts, pushing initial requirements toward $20,000 per 5,000-ounce lot. Triggered forced sales, spilled volume into the tape, and yet the price absorbed it all. Dips to $64.50 filled quietly, bids stacked underneath, and the close held firm. In a controlled system, that hike should have engineered a deeper retrace, flushed leverage, reset sentiment. Instead, it exposed the shift. Paper pressure meets physical resolve, and the metal advances anyway. The process deepens now, as deficits compound and inventories fracture further. Trace the fracture forward from that failed intervention. The CME's advisory framed it as routine volatility calibration, clearinghouse risk management approving higher performance bonds. But timing betrays intent. Right as silver tagged $65, inventories already strained from early December deliveries, claiming over 47 million ounces in days. Registered stocks dipped sharply. Eligible vaults compensated temporarily, but the net drain accelerated eastward. London reports persistent tightness. LBMA vaults down multi-year lows earlier in the year, now refilling selectively via arbitrage flows. COMEX holds bloated totals near 520 million ounces, yet the deliverable portion thins. Registered category vulnerable when Stanford delivery notices surge. This isn't surplus, it's misallocation. Metal piles in New York warehouses awaiting tariff clarity or policy shifts, while real users pull from tighter pools elsewhere. Contrast this with historical containment. 2011 cereal hikes stacked 84% over 9 days, collapsing momentum from leverage frenzy. No structural deficit underpinned it then. Industrial offtake modest, vaults ample. Kill the specs, kill the rally. In 1980, rule tweaks amid corner attempts crushed speculative peaks. Those battles stayed paper dominant. Now, 2025's fifth consecutive deficit, projected 117 million ounces short, locks in physical primacy. Mine output stalls near 813 million ounces annually. Recycling adds but can't bridge. Industrial fabrication hits records, surpassing 700 million ounces claimed irreversibly. Solar panels embed ounces per unit, EVs solder circuits, data centers conductor grids, AI infrastructure scales exponentially. Thrifting slows gains marginally. Ethylene oxide growth moderates, yet automotive and power sectors offset. Demand grows 3%, despite prices doubling from January's $31. Geopolitics interlocks the vice. Tariff threats reroute flows, sanctions fragment Russian supply, Peruvian disruptions halt pits. China forwards contracts for green tech, India imports despite rupee premiums. Sovereign accumulation quietly builds. Poland adds bars, central banks diversify reserves. Military draw intensifies. Hypersonics thermal management, drone circuitry, satellite conductors. All embed silver non-recoverably. Logistics compound. Container delays, air freight urgency spikes cost 200%. The anomaly crystallizes. No mega deposits discovered decades, grades have. Production economics fracture below $50, yet demand inflexible. If you've monitored delivery notices or vault reports this month, how do the registered versus eligible splits look from your data? Share the discrepancies you're seeing. It refines where the real pressure builds beyond headline totals. Loop non-linearly to the debt overlay, because scarcity amplifies amid fiat saturation. Global liabilities exceed $300 trillion. Yields suppressed, liquidity injections patch crises. Silver counters dilution. Unprintable, no counterparty. Preserves against promise erosion. Paper futures bet institutional solvency. Physical claims atoms. The margin spike tested that divide. System enforces with collateral demands what physics supplies sparingly. Absorption signals steel hands prevailing. Industrial desks phone OTC. Sovereign pools limit order dips. Ownership consolidates. Leverage prunes. Base strengthens. Weekend dynamics echoed this. Post-hike close held $64 plus. Asia interpreted resilience. Shanghai premiums widened. Tokyo OTC activated. No violent gap, but steady grind. Floor lifts on bought dips. Regulators' arsenal thins. Further hikes risk backlash. Position limits target scale, but accelerate parallel markets. Liquidation only threatens zombie tape. Futures $50, while physical $90. But miners arbitrage east. Vaults drain irreversibly. The bind tightens. Intervene. Fracture discovery. Abstain. Surge exposes inflation. Industry vectors exponential. Solar installs double projections by 2030. Each panel locks grams forever. EVs billions aggregate tons forward. Semiconductors etch finer. 5G embeds. Medical imaging relies. AI data centers surge power. Conductors silver dominant. Deficit stack. 2024. Red 150 million. 2025 deeper. Consumption 60% industrial. Short-term non-recyclable. For those tracking solar or EV supply chains, if thrifting or substitution is offsetting at these levels, or if forward contracts are locking higher volumes regardless, note your observations below. It maps how inelastic this demand truly is. Military geopolitical layer sharpens. Conflicts consume electronics, rebuilds demand panels. BRICS D-dollar pushes baskets including silver. Logistics. Red Sea reroutes delay bars. Urgency premiums explode. System assumes abundance. Deficit reality erodes. Compare energy parallels. 1970s oil shocks mirrored tweaks amid scarcity, but oil flows regeneratively. Silver embeds permanently. 2011 purge echoed paper dominance. 2025 inverts to physical lead. Deeper. Mine margins thin at highs. Low-grade shutdown threats below $50, yet green mandates subsidize pull. Sovereign bids unannounced. Interpretation forks here. Is $66 hold resilience or prelude? If you've paralleled copper/lithium deficits, how does silver's embedded versus flow nature alter resolution? Comment your parallels. It aligns mirrors across commodities. Process phases deeper. Symptom: absorption post-hike. To cause: deficit lock, to consequence. Parallel pricing. Erosion accelerates, not collapse, bifurcation. If spotting under-radar sovereign flows or refinery bottlenecks, what signals emerge? Drop them in comments. It completes the drainage picture. Premiums preview decoupling. Retail eagles charge maples 30 to 50% over spot in tight periods. Dealers quote delays. Paper manages headlines. Physical dictates allocation. The advance persists. Bid firms, rules strain. Pivot solidifies. Physical endures. Paper accommodates. The fracture widens. Control disperses. Scarcity asserts. Silver trades at $66.06 per ounce this morning, December 19th, 2025. Up another 0.93% overnight after brushing $66.88. Earlier in the week, the highest print in modern history. That's not volatility, it's validation. The mid-December margin hike of 10% on front-month contracts, lifting requirements past $20,000 per 5,000-ounce lot, spilled force volume, yet the tape absorbed every ounce. Dips below $65 filled on limit orders, bids layered deep, and the price closed firm near the highs. In a system still claiming authority, that intervention should have triggered retrace, purged speculation, cooled momentum. Instead, it confirmed the fracture. Paper levers bend against physical gravity, and the metal grinds higher regardless. The escalation completes now, as deficits entrench and parallel realities solidify. Follow the escalation from those absorbed shocks. The CME's notice positioned the hike as volatility management, clearinghouse prudence amid elevated risk, but placement exposes strain, executed as silver-tagged fresh records. While December deliveries already pulled over 47 million ounces in days early in the month, registered COMEX stocks thinned rapidly. Eligible categories buffered temporarily, but net outflows accelerated toward real users. London vaults, after multi-year lows mid-year, refilled selectively via reverse arbitrage. Yet LBMA holdings sit at 27,187 tons in November, valued $47 billion, masking allocation tightness beneath headline totals. COMEX totals hover bloated near 520 million ounces, but deliverable registered vulnerable when notices spike. This isn't abundance, it's compartmentalization. Metal stacks in Western warehouses awaiting policy resolution, while industry forwards from constrained Eastern pools. Mirror this against past suppressions. 2011's cascading hikes totaled 84% in days, crushing leverage euphoria from 49 to the 30s. No embedded deficit fueled it then. Industrial take modest, vaults flush. Purge the paper, deflate the bubble. 1980s tweaks amid attempted corners collapse speculative peaks. Those fights remain virtual. Now, 2025's fifth straight deficit, 149 million ounces short, cements physical dominance. Mine supply flatlines near 813 million ounces yearly. Recycling rises, but bridges nothing. Industrial fabrication plateaus at records over 700 million ounces claim forever. Solar locks, grams per panel. EVs embed circuits. AI data centers grid conductors exponentially. Thrifting trims marginally. EO moderates. Yet automotive electrification and power infrastructure offset. Demand holds firm, despite prices doubling from January's levels. Geopolitics cinches the lock. Tariff shadows reroute bars. Sanctions isolate Russian output. Peruvian labor halts pits. China secures green forwards. India absorbs despite local premiums. Sovereign hoards build discreetly. Poland stacks. Reserves diversify. Military offtake surges. Hypersonics manage heat with silver. Drones circuit precision. Satellites conduct irretrievably. Logistics amplify. Reroutes triple freight. Urgency airlifts spike 200%. The contradiction peaks. No new deposits in decades. Grades decline. Economics shut below 50, yet mandates inflexible. If you follow COMEX delivery volumes or LBMA flows this quarter, how do the registered drains versus headline builds reconcile in your tracking? Note the splits you're observing. It clarifies where liquidity truly constricts behind the aggregates. Return non-linearly to the fiat fracture, because scarcity magnifies against promise saturation. Global debt surpasses $300 trillion, yields pinned, injections perpetual. Silver rejects dilution. Atomic, counterparty-free, anchors purchasing power. Futures wager on solvency. Bars claim scarcity. The December hike probed that fault. System demands collateral for what geology rations. Absorption-proof steel prevailing. OTC phones ring industrial desks. Sovereign limits scoop spills. Leverage clears, conviction concentrates, foundation hardens. Post-hike dynamics reinforced it. Close held $65 plus. Asia red resolve. Shanghai premiums persisted. Tokyo desks engaged. No explosive gap, but relentless lift. Dips vanish, ceiling rises. Regulators' options dwindle. Serial hikes invite scrutiny. Limits fracture scale, but spawn alternatives. Liquidation only risks ghost tape. Futures $50 amid physical $90. But refiners redirect east. Vaults hollow permanently. The dilemma crystallizes. Permit ascent. Unveil erosion. Restrict. Forfeit discovery. Technology trajectories compound. Solar capacity doubles by 2030. Panels entomb ounces eternally. EVs scale to billions. Aggregate tons forward. Semiconductors refine. 5G integrates. Imaging depends. AI power surges. Conductors silver preferred. Deficits endure. 2024, short 150 million. 2025 comparable. Consumption 60% industrial. Long-term irretrievable. For those embedded in solar, EV, or data center chains, if substitution or thrifting is materializing at these prices, or if contracts lock regardless, detail your frontline view. It gauges demand's true rigidity. Military geopolitical threads tighten. Rebuilds embed panels. Conflicts consume electronics. BRICS alternatives incorporate silver. Logistics. Disruptions delay shipments. Premiums on priority explode. System presumes replenishment. Deficit enforces rationing. Invert energy analogies. 1970s oil mirrored interventions amid constraint, but oil regenerates. Silver embeds irreversibly. 2011 echoed paper purge. 2025 flips to physical command. Mine viability strains deeper. High prices thin margins on declining grades. Shutdowns threaten sub-50, yet subsidies sustain pull. Sovereign acquisitions opaque. The fork here. Is $66 consolidation or launchpad? If paralleling base metal shortages, how does silver's permanent embed versus cyclical flow shift outcomes? Share your cross-commodity reads. It refines the trajectory. Phase culminates. Symptom. Hike fails. To cause. Deficit embeds. To consequence. Authority disperses. Bifurcation matures. Not rupture, reallocation. If detecting refinery constraints or unannounced hoards, what subtle markers surface? Contribute them. It assembles the drainage mosaic. Premiums foreshadow. Retail coins 30 to 50% over spot and squeezes. Dealers extend weights. Paper narrates. Physical allocates. The surge endures. Resolve firms. Mechanisms yield. Culmination approaches. Physical prevails. Paper yields. Scarcity commands. The system accommodates reality, not the reverse. The fracture seals into new equilibrium. Control diffused. Metal ascended.